This week's chapter is about economic policy. When we talk about economic policy, we mean two broad things. In the first slide here, we mean government as manager of the economy. So government taking into consideration things like unemployment, inflation, GDP growth, and then looking to see if the economy is doing the way or performing up to standard, and if not, taking policies to increase growth or lower the unemployment rate. When we talk about economic policy, we're also talking about government as regulator of the economy. So, for instance, paying attention to pollution, rules about pollution or about economic transparency. These are quite different things, but they're both having to do with the economy. I'm going to spend most of this presentation talking about managing the economy, okay? And so when in this material about managing the economy, I want you to be familiar with some of the indicators that the federal government keeps track of. And I'm going to show you information about I'm going to give you some idea of what the target measures are, and then what's a current or recent measure is for these different indicators. And I'm going to talk about unemployment first. So of course, unemployment, the measure of people in the workforce, the target unemployment rate is generally between 4 and 5%. It's not 0% because that's not possible for a couple different reasons. Number one, businesses are always going in and out of business, and there's always going to be some people who are unemployed. Economists think that's somewhere around 3%. But also, economists and government officials have an unemployment target a little higher than that because it gives flexibility to the economy. So if you're a business owner, for instance, and you want to start up a new business or maybe expand your business, you'd like to be able to find some people to hire. So it gives flexibility to the economy. So 4 to 5% is the target. Recently, it's been right at 5%. So we're pretty close to target right now. It went up a little bit fairly recently, but we are nowhere near where we were before. Let me show you kind of where we've come from. This is 2007, the end of 2007. Bush is still president. This is when Lehman Brothers fails, right in here, and this is when basically, the economy begins to become unraveled, and within just a few months, we're up to 10% unemployment. And so most economic policy since then, economic management, has been about trying to stabilize the economy in the wake of this pretty severe recession. Now, the way that it's measured is that the Bureau of Labor Statistics has about 60,000 households that they call up and ask 3 questions. First, did you work last week for money? Number 2, if you didn't work, did you want to work? And number 3, if you didn't work and you wanted to work, did you actively seek employment? And answering no to the last question, for instance, means that you're not considered unemployed, even if you are someone who simply stopped looking for work because you can't find work. So these numbers don't capture those people, and they also don't capture people who are underemployed. So you say, yes, I worked last week for money, but I only worked 5 hours and I'd rather work 40 hours, or I'm only making minimum wage and I used to make $20 an hour. Those things are also not captured by these numbers. Those other measures are taken, however, and they're important, but this is the official number. And what's important about that is that the Bureau of Labor Statistics is quite transparent about how they collect this. Everybody knows that it doesn't include underemployment or people who've dropped out of the workforce, but they measure it the same way every single time, and so it is a pretty standard measure. But anyway, so 5%, and of course, just because it's 5%, it's at the target. Because of those other issues, people's incomes are not nearly what they were before the recession. A lot of people are still underemployed. This is not really acceptable for the federal government. So they've still been working, trying to bring this, the employment situation more into an acceptable frame. Now, inflation is another measure that they keep track of. Of course, the rise in prices. So trying to get a stable inflation. Now, a little bit of inflation is desirable in a healthy economy, and the inflation target is between 1% and 2% a year. If you own a business, you'd like to get a little bit more next year for your goods than you did this year. So a little bit of inflation is a good thing. And when they measure inflation, they do take out food and energy costs. So this blue line right here is kind of the measure of how prices feel to the citizen. But this is not really what the government is most interested in when they're tracking inflation. What they really want to know is whether the underlying money supply is appropriate. And that's what this red line tells them. So you subtract out food and energy, and you can get a sense of how the money supply is, if it's too much or too little. So the target, like I said, is between 1% and 2%, at about 2.25%. Here, just a little over target. And so this is important. The government's certainly watching this closely. Now, back in 2011, the inflation rate was down here, well below target. And this was very troubling coming out of the recession, because policymakers were much more worried about deflation than they were inflation. So a deflationary cycle is when maybe you have a bunch of stuff for sale and you can't sell it, so you lower the price. And when you lower the price, you have to lay some people off because you can't make payroll anymore. And then those people don't have money to spend, so other places have to lower their prices, and then they lay people off, and so on and so forth. And so this is called a deflationary cycle. And economists will say that a deflationary cycle is much more difficult to combat through government policy than an inflationary time. And so what was happening since 2011 and until fairly recently is that the federal government was basically flooding our economy with money, increasing the money supply pretty dramatically. And they've eased up on that recently, but that's been driving economic policy for quite a while. They also keep track of gross domestic product and the growth in gross domestic product. And this is the formula here, C plus I plus G plus exports minus imports. And I'm going to give you an illustration of that. But the target growth rate is between 3% and 4% a year. And let me just take you to the current or recent numbers on this. So this is the gross domestic product. So you can see here in second quarter of 2016, total gross domestic product was $18 trillion. So that's the value of all the goods and services created in the society in a year. And the biggest chunk of that is what we call personal consumption, the things you and I purchase. That's about 13 trillion of that. Investment is about 3 trillion. That's, building factories, also a house the first time it's built, other kinds of things as well. Exports minus imports. This is the trade deficit. So we want to subtract imports from exports, because exports increases our GDP because we're getting value from other countries. But when we import things, it's sort of like sending our value abroad. So right now we're at a minus 492 billion. And then finally G, these are the things that government purchases. And you can see part of this is federal and part of it is state and local governments. Now, the rate of growth, let me just take you to that real quick. Between 3 and 4% is the target, and in the second quarter of 2016, the economy was growing at 1.4%. So fairly low. It's quite out of target. And so this is one of the things, you know, when they're keeping track of this stuff, you can see also that it's fairly unstable. 4%, and then 5%, and then 2, and then down to 0.9. And so this is really pretty unacceptable from the standpoint of federal government economic policy. Now, the reason, you know, this 3 to 4% target is what's considered by economists to be somewhat achievable and stable, to be stable over a long period of time in an economy like ours. Now, we hear often that countries like India or China are growing at 6 or 7 or 10% a year in some cases. Most economists would say that that's quite out of reach for a country like ours, where we don't have this kind of vast reserve of low-wage workers available. And so 3 or 4% is the target in our economy. We also keep track of, think about the budget and the federal budget deficit. And so understanding the difference between a deficit and a debt is important. Debt is the overall amount owed by the federal government, and the deficit is the amount by which expenditures exceed income for a year in the federal budget. Now, we just take you to a couple slides about this. Let me just show you. This is kind of outdated, but when we talk about the federal debt, most policymakers talk about the debt to GDP ratio. So not the level of debt so much as the debt to GDP ratio. And you can see the highest that was the highest right after, while we were in World War II. Receipts were still fairly low from the Great Depression, and we were borrowing a lot of money for the war. And then we go through this period of sustained economic growth through the 1950s and 1960s in this country, and you can see the debt to GDP ratio drops through that whole period. This is Republican presidents, Democratic president, Republican. This is, we start to kind of turn the table in the 1980s. During that period, taxes are cut somewhat, but expenditures increase. This is the Reagan administration, and they're spending money on foreign defense, and so you can see the debt to GDP ratio going up. Goes down again under Clinton, and then here's the Bush administration. It starts to go up again. Revenue to the federal government was cut, so they cut taxes during this period, and we're also borrowing money for the Iraq War, so the debt to GDP ratio starts to go up again. And then this is the beginning of the financial crisis. This is the Obama administration. Of course, when he comes into office, the economy is at 10% unemployment, and so that means that the receipts to the federal government in terms of an income tax are fairly low because so many people are out of work. But also they're borrowing money to try to get the economy going again. That's the Recovery and Reinvestment Act, and we'll talk about that a little bit later. The debt to GDP rate